In order to get the mortgage as soon as possible, there are a couple of steps you should be aware of before. First, compute your monthly income as well as your monthly debt obligations. Your lender would want to know your monthly income and how much of this goes to pay off debts. So prepare the documents to back up your computations. Gather at least 2 weeks of recent pay stubs because you'll need to provide them to your lender. If you're self-employed or have variable income, it gets a little bit more tedious. The lender might ask for a copy of your past 1 or 2 tax returns. Some lenders would compute the average of your last 2 years' income. Others might use the lower one as the basis for their evaluation. Another important item to remember is about staying within certain ratios that lenders use to compute your loan amount. The lender may lessen the amount of your loan you can get when they see that you are saddled with debts. If you're still paying for your student loan, auto loan, and other loans, it will affect the new one. If it's possible, pay off all or some of these debt loans first, and avoid getting into new debt. The second important thing to remember is to check your overall credit profile. It would be wise to check your credit score and get your credit history report before you apply for a loan. You specifically want to check that there is no error or negative information on your report like a past due item. While you are still looking for a house, you can subscribe to a service that monitors credit. You can get an updated personal credit report for around $20 a month. You can cancel your subscription after you've closed with your ultimate seller. You should have a FICO score of not less than 680. If you were above 700, it would be a lot more favorable. If any less, you may have a harder time getting a loan. The bank may require you to get a highly qualified cosigner. This may even require you to improve your credit score before you get a loan. Remember too that a lower credit score usually means a higher mortgage rate. If your credit score is less than 680, you may want to consider getting an FHA loan. These government-insured loans accept borrowers with lower credit scores and lower down payments. The catch is, you may have to pay some additional costs. Lastly, avoid applying for a new credit line in the few months leading up to your mortgage application. Banks do not like borrowers who appear to be piling on new credit. In such case, even applying for a new mobile phone subscription could raise a red flag on your lender. They might ask you to write a letter of explanation. After you know what is your credit rating, it's time to set your mortgage budget. Before you even talk with a mortgage officer, you need to determine 2 important items. The first is how much you can realistically afford. The second is how much in monthly amortization you'll be comfortable paying. A good rule is to set a cap to how much of your income should go to your total housing payment. One rule is to not go over 35% of your gross or pre-tax income. This should include all fees, taxes, and insurance. For example, if you have a total annual income of $84,000, 35% of that is $28,560. Breaking that into 12 months would give you $2,380 per month. That limit would be on the high side. You could lower it to 25% of your gross income. You might find some financial advisors who will give it a more conservative percentage. This is just a guideline because it really is kind of difficult to equate your monthly payment to a fixed home price. Your actual monthly expenses will contain variables like interest rate, property taxes, house insurance, etc. You may not be able to compute the exact amounts, but your agents can give you a fair estimate. The next step is to compute how much you can save for the down payment on your new house. Most lenders will require that you put up anywhere from 10 to 20% of the cost of the house. It would be lower if you were applying for an FHA loan or other special programs. If you can afford it, we suggest that you go up to 20% on your down payment. This will exempt you from getting a private mortgage insurance, or a PMI. This is a security that protects your lender should you suddenly forfeit on your loan before establishing sufficient equity. It's insurance for them, but you will be the one paying for it. It's an expense that you want to avoid totally. Make your mind up as to the maximum budget for your house before going through the approval process. There will be a temptation to buy a bigger, fancier house. Your agent or some unscrupulous lender may sway you with the argument that your property will appreciate later. Sometimes you might suddenly get capricious and go over your original plan. It's better to buy something you can pay off quite comfortably and enjoy peacefully. Going to a bigger house and eventually losing it to the bank will haunt you and your family for a long time. Think that through before you sign on the dotted line. As you can imagine, the pre-approval process is a serious step. It will formally signify your involvement. That's it for now. First, on our website, you can find more mortgage podcasts as well as calculators and other financial application fee. Do you have an experience you will need to submit to the lender a couple of documents, so please so they can do a background check. On the comments below. They will extensively check your financial condition. Don't forget to subscribe to our podcast channel on YouTube. Rating. And we'll see you can proceed to this step, though you haven't found a house yet. Leave any